it makes perfect sense. Obviously, it's a hugely globally oriented market. And as far as sterling keeps falling, that directly repatriates to higher profits for many of the constituents of the index. So broadly speaking, it should be quite positive. It reminds me actually of the immediate aftermath of Brexit, where most expected, oh my goodness, the UK equity market is going to be hit for six, and quite the opposite. Actually, it had a dramatic turnaround in the immediate hours after Brexit, and ended causing quite a run, simply because of the inverse correlation with sterling, which I think still holds very strongly.
Fahad, of course, everybody is focused on what the budget announcement meant for sterling. The problem with trying to get clear analysis on this is it was only £45 billion. And I say that advisedly, given the scale of the government financing. 45 billion is a chunk of change, but it's hard to believe that that's the only reason why the pound has fallen so heavily. And it doesn't explain why the euro is, at a 20-year low, and why the Swedish krona has actually done as badly as the pound at this point. Can we talk a little bit about how this is a dollar story and what ultimately that rush to the dollar means for all asset classes?
Well, yeah, look, I mean, you're absolutely right. I mean, sterling, even in spite of the last, 48 hours of trading, is still better than the yen has been this year. Clearly, the yen is not affected by the UK budget. So the point is, it's absolutely been a dollar story. The U.S. economy is on a much stronger footing. It's we've seen 1 million jobs created there over the last 3 months. Which is spectacular performance, and rates are rising there in the face of red hot aggregate demand. Very different to the reason that rates are rising in much of the rest of the world, particularly the UK. And Europe, where it's much more defensive and much more in a bid to control inflation, but inflation that's being driven by an exogenous shock, not by demand. So look, it has undeniably been a dollar story all year now. Over the last 48 hours, I would say quite rightly that sterling has fallen and gilt yields have risen directly because of activities at home, which we all know about. But the dollar story, I still think, has legs. I mean, the U.S. economy is still relatively stronger. Rates are still likely to rise there for the reasons that you'd want them to, which is controlling aggregate demand. I can't say the same for the UK. Clearly, we are in the position here where something's got to break. Sterling is the thing that seems to be taking a lot of the pressure right now.
Inflation has been driven, as we know, by higher energy prices, and a lot of that has been factored in because of concerns around the war in Ukraine. But the one bright spot, I guess, over the last few days has been the fact that energy prices are coming down very quickly as we see this financial sector risk aversion and volatility. I mean, look, we're down $20 since the end of August on Brent. Is there a chance here that actually we may see a more positive outcome in energy prices, and perhaps economists' glide path on inflation needs to be adjusted lower if we continue to see these prices fall?
Look, you're right. I mean, clearly the falling energy price is going to help headline inflation. There's no question about that. Okay, the reason the energy is falling obviously is because energy markets are predicting a deep recession and a huge loss of demand. That is obviously not a good thing. So let's put that aside for a second. But purely mathematically, you're going to see a fall in the headline CPI figures simply because of falling oil prices, right? So that's that. But the problem is that actually inflation has broadened far more widely than just the oil prices. And if you take the core numbers, which are X of energy and food and other volatile items, you will likely see that inflation is still set to rise for some time. There's huge wage pressures in the UK. There's a lot of overhang from Brexit. That doesn't allow us really to take advantage of the cheap sterling as much as we would have done in a previous era, given that our biggest export market is very challenging, particularly for small exporters. So, the oil price falling will help, but ultimately inflation has gone beyond just the oil price and commodity prices. It's much deeper and more entrenched, ultimately linked to things like rent and wages. And we'll have to see what happens there. I do believe that a recession is here and likely to deepen in the UK, and that may well, um, unfortunately, with the problems it does cause, but it will help temper some of that upward pressure and inflation in non-oil items.